Okay, we're going to get started today by looking at the S&P 500 like we usually do. We had a down week. The S&P 500 was down 2% last week. You can see by the uh, by the chart here that we're very close to retesting lows from March. So we're 1% away from that. So it almost looks like a foregone conclusion that we're going to at least test this level. Whenever we're in a downtrend, like we started right here when we broke this moving average, it seems as though we have circuit breakers. And whenever we have past levels of support, like right here and here and here, those are the levels that the stock market stops as a circuit breaker. And we do know for the past couple of years, we've been saying that the S&P is overvalued versus historical means. So right now the S&P 500 is 23 times PE. So the average PE for the S&P is around 17. So looks like what's happening right now is we have a lot of uncertainty in the stock market. So a lot of um, we've had we've had a lot of expensive stocks in the stock market, and whenever there's uncertainty, stocks usually trade down to their fair value. So let's look at some of our talking points. Okay, we are going into March, which traditionally is one of the April, which is one of the better months of the year. But when we're in a downtrend, all that doesn't matter. So right now we're in a situation where we have a lack of confidence, lack of clarity, and there's fear in the market. So all that translates to all of the we have we could have to a spot where we have capitulation. We haven't had that yet. We haven't had a lot of volume on our selling days. So let's look at some of our talking points. We have no movement at all in the 10-year and in the 2-year. So we have the S&P down almost 2% from last week. Seems like the Fed is trying to figure out the situation with the tariffs and inflation. We had a very hot inflation report, so there's the chance, whenever there's a hot inflation report, the chances of the Fed reducing interest rates goes down. Okay, this is our theme from the beginning of the year. Revert to the mean, and this is really happening now. We have healthcare, telecom, financials, energies, and utilities outperforming the tech stocks. And this is an example of contrary investing. No one at the beginning of the year thought healthcare, telecom, financials, energy would be good performing sectors, but now they're outperforming. Yeah, S&P is really high right now. It's 23, but over time it'll revert to 15 PE. So we have to be ready for that drop in valuations. We have zero momentum in the stock market. 33% of the S&P is above the 50-day and 39% above the 200-day. So we are definitely not in a momentum market. And so with the big, we have a lot of uncertainty in the market. We have a meeting coming up in April 2nd. See, let's look at okay, April 2nd. That's this Wednesday. We have a tariff announcement. So there's a lot of fear that a lot of the companies that rely on knowns for giving their estimates and predictions and hiring and firing, they can't predict things anymore because of this tariff. So we have a lot of uncertainty in the market, and because of that, um, there's selling in the market. So let's look at some more talking points here. Okay, so the S&P broke the multi-year uptrend right here in about beginning of in the mid-February. And we've been going down in this downtrend. So it seems like we could we have a spot here where we traded down to in March, in the middle of March. And it looks like we're going to retest that. That means it goes back down exactly to that level. We could bounce from there because there's a couple things in mind in traders' minds. First of all, we're starting a brand new month. Okay, so a lot of times you get rid of the you get rid of a quarter and you do a lot of last minute manipulating for the quarter. Now, this is the beginning of a brand new quarter. We have earnings coming up, which could be a catalyst. And we have the banks reporting not this coming week, but next week. And of course, the tech stocks come into last week of April, and then we have NVIDIA in the last week of May. So a lot of times earnings helps the stock market. That's why April has traditionally been a good month in general. Okay, so let's look at some of our. Okay, so again, we're in a downtrend right now, and we could be making lower highs and lower lows. So we have a big test right now, this coming Monday and Tuesday. If we test and we bounce up with a lot of support, um, then and we have to break through this downtrend. Otherwise, we will be going down to here, which is a lower low, and following this pattern. So let's keep an eye on that. Okay, this is the 10-year versus the S&P. We're at a one-to-one correlation now, and the translation is um, the U.S. economy is slowing. Because of that, the yield on the Treasury, 10-year Treasury, is going down. And if the economy is slowing, then stocks won't be as profitable. So that's why the stock market is going down. So let's look at some of the variables in the stock market. Um, Oil is $69 a barrel, and that is pretty low. It's up a little bit from last week, but in general, it's predicting slowing economies around the world. And we haven't had a whole lot of changes in other variables. Inflation is about the same as last week. The US dollar index hasn't changed since last week. It's still in a downtrend. Gold is up 3%. And it seems like gold is up as a supply demand issue. Right now, we have a lot of uncertainty in the stock market. Central banks are buying a lot of gold, and the supply demand imbalance is making the price go up most likely. So we have let me see. Okay, we have the dollar index. You can see it's in a downtrend recently. That's going to help the tech stocks. Whenever the tech stocks report in a month, we're going to find out they're going to be helped by currency, like maybe 3 to 5%. So that is going to be good for the multinational companies. Okay, greed and fear index, we're still at extreme fear. So the majority of the market is fearful. We have amateur investor surveys still bearish. So we have fear in the market. This is very close to capitulation. So we have VIX. It's only at 21. So it's still fear is beginning, but it's not really when we can tell if it's capitulation whenever we have the VIX up to 30 or 40. So we're about right here in the fear in our emotional chart. So we have a lot of fear in the market. And whenever there's capitulation, which might be in the following week, that's when Warren Buffett comes out and starts buying things. And Warren Buffett says whenever others are fearful, that's the time that you have to be greedy. We've had a big sell-off in Magnificent Seven stocks. So the overvaluation in the Magnificent Seven going down to fair value. That is happening in a major way. And so there's a lack of confidence now in the AI story. So this is one of the reasons why the stock market's selling off now. And so, yeah, the massive government layoffs may slow economy. That is definitely happening. And we have random Trump actions or words. We have tariff threats. We don't know what's going to happen this Thursday, no, this Wednesday with tariffs. It could be a bluff, it could be a negotiation tactic. Regardless, it makes uncertainty in the stock market, and that's going to lead to people paying less for stocks. Okay, this is becoming very appropriate now. We've been saying this since for a couple of years now, I think. The PE ratio in the S&P is 23. And in according to this chart here, the whenever the yields are at 4.3%, the stock market has a PE of 15. So that means the stock market can correct, in a major way to get to a fair value or some kind of mean. So returning to the mean is kind of a um, theme for this year. You can see in the past month, the Mag 7 stocks, the biggest stocks in the S&P 500, they have corrected and much more than the average stock in the S&P 500 minus the Mag 7. So you can see that this thing we've been worried about for a while, which was Magnificent Seven overvalued, may go down to fair value. That's actually happening, and that's what's making a good portion of the stock market correct. Okay, so our first to worst. We've been tracking this from the beginning of the year. The best performing sectors from last year are now the worst performing sectors, and the worst performing sectors from last year are now the best. You can see energy is actually the best performing sector at 8.4% for the year. Healthcare is second at 5.13%. So this is just an example of contrary investing. At the beginning of the year, we were saying investors will be reaching for stability amid chaos. Investors will prepare for a slowdown in the economy and chaos. So whenever that happens, people reach for utilities, healthcare, consumer staples, and companies that pay dividends. So I didn't put gold there, but gold is also something that's bought whenever there's uncertainty. A weak dollar, whenever there's a weak dollar, we have companies overseas will be positively affected. We have price of goods from overseas goes up and the price of commodities go up. So, and we're still trying to figure out the effect of tariffs. And no one really knows the effect in the end of tariffs because we don't, it changes every day. So, let me see. All right. So let's look at, okay, this is a good time to look at Schwab's asset quote. It was updated as of last week. You can see that the best, every year, it's very important to have a diversified portfolio. And that's because different sectors perform differently every year. So you can see that this year, energy is the best performing sector. But if you look at last year, it was only up 3% and 2%. And so right now, let's see, Infotech has been doing really, let me see. Well, IT has been doing really good for the past couple of years, but now it hasn't. It's down. So it's very important to diversify your portfolio so that whenever um, there's a downturn in the stock market, you can have some that balance that out, some investments that balance it out. Now, let's look at some of the stocks going up and down. Okay, here it is. Let's look at, okay, the ones doing the best. These are all utilities. healthcare, and energy. Okay, so if we go back to our, let me see, our theme from the beginning of the year, utilities, healthcare. I didn't have energy in there, but these are all sectors that pay a high dividend and are considered safe and consistent. The ones doing the worst, we have Lululemon. Okay, we have a theme of consumer facing products. Most of these are products that have a lot to do with consumer, and we've seen a lot of cracks in the consumer these days. We had Walmart saying that the consumer is not so good. We've had a lot of retailers, and we have Lululemon. They mentioned that they're not going to have uh, good earnings going forward. So Dollar Tree, of course, they're consumer facing. So if consumers get scared of spending and they pull back and they max out the credit cards, they're not going to have go on airplanes, Delta Airlines. They're not going to go to the um, gamble their money at the Caesars. Okay, and DoorDash, they're not going to order food to go out because they're going to have to make it at home. All right, so we do have a theme where um, the stock market on Friday was worried about the consumer spending. Let's look at Lululemon because um, Lululemon, let's look at their basic finance, their statistics. You can see that their PEG ratio is 1.1. That means they're almost fairly valued. They have traditionally been overvalued, like maybe a PEG ratio of 2 or more. Um, their forward PE is 18, and that's a little bit less than the stock market. So it's kind of undervalued. It's kind of fairly valued. The interesting, not fairly, yeah, they're almost fairly valued. The interesting thing about Lululemon, their profit margins are 17%, return on equity is 42%. So both of those match our criteria for a good stock. Um, their business model is they have their goods made in China, um, yoga pants and yoga shirts, and they mark it up in a major way. So they sell their yoga pants for $100, and they might make them for $1 or $2. So that's their business theme. But now we have tariffs that are cutting into their margin. So everyone is looking at this return on equity and the profit margin um, going down because of the tariffs and because other factors, maybe inventory. Let's look at the earnings estimates from this year to next year. 1464, 1508. That's not very good. Let's look at 115 divided by 1464. That's 3% growth between this year and next year. That is a far cry from where they used to be. So that means if they're only growing at 3% and their PE is 18, then they're 5 times overvalued, or at least. And I'll just do some eye calculations. So they're growing around 11% for the next couple years. So if they're growing 11% after this coming year, um, and you have a slowdown in the consumer, and we have uncertainty and possible more tariffs, this is a good one to stay away from for now. Anything retail is going to be very challenged in a high tariff environment. And because of that, you're going to have stocks that say they don't have a lot of um, vision in what their earnings are going to be in the next quarters because of this maybe tariff uncertainty. So we have a whole. So as you're thinking about investing in this environment, retail is going to be one of the most challenging. environments. So let me see. All right, let's go to some more talking points. Okay, let's look at Dan Nowell's picks from the beginning of the year. Um, Cisco up 3%, ADTN up 7%. The bank ETF, big bank ETF, is minus 5%, and the cash is 4%. It looks like cash is one of his best picks this year. And his picks from last year, Meta is still up 67% since the beginning of last year. KWeb is up 34%. KWeb is another example of a contrary investor. The Chinese stocks were down for several years in a row. He was a little bit early in his call for Chinese stocks to outperform, but now even this year they're starting to outperform. And Amazon is still up 32% from last year. All right, so let's look at a question from Mark O. And he said, should I buy Casey, Casy? Okay, so this Casey's General Stores, and they basically operate convenience stores in the Midwest. They offer pizza, donuts, breakfast items, sandwiches, tobacco, nicotine products, and gas. So they're very similar to a 7-Eleven or, um, but they operate in the Midwest. So so I looked at their financials, and it seems as though I looked at their earnings estimates going forward. It seems like from last year to this year, they were going at 5%, and then it seems like they're going at 13%. So, and I looked at their growth rate. Let me see. Their PE, forward PE is 24. If they're only growing at 13%, then the PEG ratio is 1.84. So that's 1.84 times overvalued. So if you calculate it out, if they're trading at $400 a share now, then the fair value is 217. So I was looking into some of the reports on the stock. The positives is it does have a niche in the small rural towns where other operators don't operate. So they make 75% of their money from in-store purchases and that are not gas related. Um, Actually, most convenience stores such as 7-Eleven make most of their money from um, buying things in the store, not the gas. So um, so right now it seems like they're overvalued. We have consumer confidence going down. You saw with all of the consumer related stocks going down in the top movers today. And whenever you have a stock that's consumer facing and consumer discretionary is one of the worst performing sectors to date, um, they have competition from dollar stores, quick serve restaurants, and there's also a problem with EV vehicles affecting the demand for gas. So if people aren't going to need to fill up for gas, then they're not going to go and buy something in the convenience store. So, so the price of gas is going down. So that's going to reduce their margins for buying gas, and that might reduce the gas profits. So I'm looking at all the negatives. Um, Berkshire Hathaway owns Pilot, which is a competitor, a nationwide competitor, and they have a very similar business model. So you're going up against Berkshire Hathaway in a way. Um, I guess the difference is Berkshire Hathaway's Pilot is on the interstate and major roads, and this company operates in a niche area where other companies don't operate. So the company it doesn't have much of a moat, and it's expensive. There's not a whole lot of margin for safety. So in other words, if the stock is trading almost double its fair value, then in a market downturn or if consumers cut back, then this stock will go down because there's not a whole lot of room for for safety. Okay, so we're in a very challenging time for the economy, and in a bad tape, it could go down to $200 a share. Okay, so let's look at some more of the financials on this. The market cap is only 14 billion. Its forward PE is 24. Its PEG ratio is 1.9. So Yahoo Finance agrees that it's almost 2 times overvalued. Its profit margin is 3.44. That is razor thin margins. That means they're not making a whole lot on on their products that they sell. So if you have Twinkies that cost $1 from the distributor and you sell it for $1.03, that's your 3-cent profit margin. And that's not very good at all. We like to have at least 13 for a profit margin. Return on equity is 16. That is decent. We like at least 13 for return on equity. So I guess one of the major things that they have to work on is their profit margin. And the other thing is, let's look a little further down here. Okay, their total debt is 3 billion out of a 14 billion market cap. So 3 billion minus their total cash, that's like 2.5 billion debt out of 14 billion market cap. I guess that's manageable, but that's something that's a negative on the company. So they have to work on paying down this debt. And okay, so they're obviously a profitable company and they have a very small, less than a 1% dividend. Okay, overall, it seems like a decent company, but I would wait until it goes down in half to buy some. And it's not a very exciting company anyway. So, all right, so here's the stock chart of Casey's, and it seems like it follows the S&P 500 almost to the T. So, um, it looks like, yeah, it looks like a very dicey time to buy this company. All right, so, oh, here's the little write-up on Morningstar. Morningstar says they're 29% overvalued, and the fair value is around 295. They say they're worried about the margins of the company um, and about how gas prices have affected their margins. And okay, if the price of gas goes up, then they're going to reap benefits from that. But right now, price of gas has been going down. So, um, see. Okay, and they also mentioned electric vehicles pose a threat to long-term gas demand. All right, so Morningstar thinks it's 29% overvalued. Let's look at actually CFRI didn't have an opinion on it, so I didn't include their report. Okay, let's look at some of the best and worst performing stocks in our watch list. Um, okay, some of our best performing stocks have been telecom. We have AT&T, T-Mobile, Amgen, Berkshire Hathaway. So AT&T that pays a high dividend, and there's consistent demand, and it's most of their money comes from America, and it's not affected by tariffs. Same thing with T-Mobile. They are not affected by tariffs, and most of their um, money comes from America. Amgen, a drug company. We have Berkshire Hathaway. They have $300 billion in cash, and most of their money comes from America also. So we have a theme now of stable companies that pay a dividend that are America-based. Gold is up 15%. We have Abbott Laboratories, which is a drug company, AbbVie, which is a drug company, Johnson& Johnson, a drug company, Waste Management, and they do um, They have a duopoly with Republic Services, and so demand of waste um, is good in good times and in bad times. So this theme from the beginning of the year seems to be working for that part of our portfolio. The ones doing the worst, Tesla is down 30%, Novo Nordisk and Nvidia, Google, and uranium down the most. And one thing that's interesting about whenever we have a market sell-off, and like we're starting to have a market sell-off, um, when people are worried, they buy liquidity, meaning they'll gravitate towards the Google and the um, Apple and Microsoft whenever whenever they're looking for something stable that pay dividends. So watch out for that. Okay, so we're going to have an April 2nd tariff announcement. This is totally messing with the the upward trajectory of the stock market for the past couple of years. This basically, the tariffs that the president is imposing is really messing with the business models and um, the estimates and predictability of the stock market. And as soon as we get some clarity on this tariff situation, um, the stock market will settle down. But what's been apparent is these deadlines that are set by the president are like negotiating tactics, and it's going to be ongoing for 4 years. So if you think it's going to be over on April 2nd, it's not. It's going to keep going, and this uncertainty will last probably for 4 more years. And because of that, the stock market is going to trade down closer to the average PE for the stock market, which is around 17, if uncertainty persists. So we'll see what happens on April 2nd. Okay, let's look at some of our charts. Um, this is the chart of gold, and you can see it's like at the top of its trading range, and it's overbought. And in an environment like this, where central banks are buying gold and people are buying gold for um, safety whenever there's craziness in the world, um, this continues to be one of the best looking charts in the stock market right now. Let's look at Google. Google is a fair value of it's trading below its fair value at like a 0.9 um, peg ratio. You can see it broke through its uptrend right here, and it could be going into a little downtrend. We don't know what's going to happen there, but um, it's halfway between overbought and oversold. And I would say it's still in an uptrend, a multi-year uptrend. And there's a lot of support whenever a big stock trades down to its fair value. So let's look at, okay, I'm going to pull up our stock screen for this week. Okay, so our stock screen for this week, you can see Google has a peg ratio of 0.96. So it's growing around 13% a year, and it's trading right about its fair value. And what I did with this stock screen is I looked at some of the stocks that would benefit from this kind of environment. Or what I did was I looked at the stocks that have monopolies. Whenever the stock market's selling off, a lot of times the good stocks are sold off with the bad, and stocks that have monopolies will often trade down to their fair value. And here are some stocks that I think are close to monopolies, not monopolies, but Alphabet. They have 97% of the search in the world. Um, we have T-Mobile for America, they are the best number one telecom company, and they're growing. And they're in one of the sectors that are doing the best this year, which is telecom. We have here's one right here. It's Canadian National Railway. I'm keeping my eye on. It seems like they're a little bit overvalued, but they have a monopoly. They just bought Kansas City Southern, and they have a monopoly of the rail traffic between America and Canada. So I'm going to go over CNI because I know Bill Ackman owns a good portion of that. Um, and let's look at, okay, Berkshire Hathaway. They have a large cash position right now. They have 300 billion in cash. They were selling stocks last year when everyone else was buying. And now they have an insurance company. They're mostly America based, so they don't have to worry a whole lot about tariffs. And the products that they sell, such as insurance and um, railroads, aren't really affected by tariffs a whole lot because they're America based. Let's look at MasterCard. MasterCard is still in an uptrend, even through all of this. You can see that they're overbought right now, but they're still within this channel of an uptrend. So this is one of the strongest stocks right now in the market. Just think about the tariffs and how the current environment will affect MasterCard. Um, Even if there is inflation, that will help MasterCard because they're a toll collector. They take a portion of every dollar that's spent in their network and around the world. So, so they will do good in the scenario where customers are cutting back um, because the prices that they pay are a little bit more with inflation. And if there are tariffs, then people pay more for their items, and that's better for their bottom line because there's more transactions in their network. So I don't see they don't take any credit risk. They're not consumer facing because all of the credit risks are taken by the banks that support their network. So that's the example of why this company seems to be doing okay. They're growing around 20%. Let's look at eBay. eBay, again, they do a lot of digital sales. So digital sales isn't mm, isn't a whole isn't affected a whole lot by tariffs. They do have a lot of overseas transactions that involve they might have to put tariffs on. There's a little bit of work involved there, but most of their what they sell is digital. Because of that, they're not a whole lot affected by the current problems with the administration. And if there is bad times and we go into some kind of recession or people are cutting back, they'll buy things on eBay instead of buying it new. Okay, T-Mobile, let's look at that chart. They're hitting basically an all-time high. They are overbought and they're in one of our sectors, the telecoms, that seem to be United States based and not affected by tariffs or the current administration issues. Okay, we already looked at our stock screen. Um, and let's look at CNI, which is Canadian National Railway. Um, Bill Ackman, a lot of times I like to look at what other investors are buying and holding in their portfolios. Bill Ackman made a purchase of this a long time ago, and I sometimes I just wait for stocks to go on sale and start looking at them. So let's look at CNI, Canadian National Railway. They had a strike last year, so that kind of affected their stock a little bit because they couldn't get um, a lot of their operations stopped for a while. So I guess right now I looked at their earnings estimates, and it seems as though they're growing around 11% a year, 11 or 12%. So from this year to next year, it's 12%. So their forward PE is 17. They're growing at 12%. So the PEG ratio is 1.4. So a little bit overvalued. They have a monopoly in railroads between US and Canada, and they just bought another, um, they bought a United States competitor, which allowed them to go into Mexico. So Bill Ackman is an activist investor. I like to look at railroads because they're not going to make railroads anymore. I mean, the railroads that are out there right now are the last ones that'll probably ever be built because it's almost impossible to build them. So they're not building railroads anymore. So there's a monopoly. And what's happening is a lot of these um, railroads are increasing their efficiency and they're taking over other railroads. So eventually there's going to be two major railroads in the world in North America. And see, so I like to look at um, stocks that have monopolies when the stock market is selling off. Right now, it seems like this is just a little bit overvalued. Some negatives for the company. They have 21 billion in debt out of 61 billion market cap. So they spent a lot of money buying um, Kansas City Southern, American company, a couple of years ago. So they're very sensitive to interest rates until they pay off that debt. Um, and also, U.S. Canadian trade is on the edge. We don't know how much um, the current administration is going to affect how much things are going back and forth between the countries. So if there is a sell-off because of U.S. Canadian trade issues temporarily, I guess we can revisit this. Let's look at some of the statistics. The forward PE is 17, and the profit margin is really good. It's 26. The return on equity is 21, and those are almost double what we're looking for. So the total cash minus the total debt is around 20 billion out of market cap of 61. So that's a lot of debt. So a big story for this company is paying down this debt and keeping the profit margins higher. So if I looked at the Morningstar, Morningstar says that their fair value is 108. So they're undervalued according to Morningstar. And as far as CFRA, they say that it's overvalued by 8%. So we have, it's basically almost fair valued if you mix both those together. So I like to look at the CFRA's small little write-up on it. They basically said they have weakening margins can, compared to historical level. And they said volumes might be picking up into 2025, but that might be affected by tariffs. So there's some competitive risks given the merger with this Kansas City Southern. Okay, so basically, all this is saying that it's fair. It's one says it's undervalued, and the other says it's overvalued. So it's very, very close to fair value, I guess. 1.4 is what I came up with. So for me, I would wait until it comes down to a PEG ratio 1, and then I would look at it. All right, let's look at the chart. It basically, I pulled the chart up going back to 2021. It basically hasn't done anything in 5 years. But it did correct in a major way during the pandemic. You can see in the past, you see, the past year, it's been going down in a major way there. So um, so I don't see anything exciting about this right now. But if there's a monopoly available and it's trading on, it's for sale and it's undervalued, then I would definitely want to look into that. And because this is like almost a consistent 11% grower, um, and it has monopolies. All right, so let's look at, I think that's it. Okay, so that's all I had to say for today. I hope you enjoyed that talk and hope you have a good week ahead of investing.